Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Green versus Brown Initial Public Offerings, How Do Green IPOs Fare? We are grateful to Ivan Diaz-Rainey from Climate and Energy Finance Group for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our speaker. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We have allocated sufficient time at the end of the webinar to address these. And now I would like to introduce you to our speaker, Dr. Ivan Diaz-Rainey, Director of the Climate and Energy Finance Group and Associate Professor of Finance, University of Otago. Ivan, over to you.
Good morning. Thank you very much, Dave. It's a real pleasure to be with you all. So thanks to you, Dave. Thanks to IAE and those that have joined. So I guess I'll start by sharing my screen. Would be a good start. And I think you can see my PowerPoints now. Is that correct, David?
Yes, I can.
Okay. So yes, today we're going to look at this paper entitled Green versus Brown Initial Public Offerings. How do green IPOs fare? It's the first time we've presented it, so we're very keen to get feedback on this paper. It's joint work with a student, Freddie Cleverly, here at University of Otago. Actually, he's now moved on to the corporate world, and Pia Helbing from the University of Leeds. And yeah, we look at initial public offerings. So let me start with a little bit of introduction. So clearly, clean energy finance and climate finance are 2 issues of high prominence at the moment. And there's all sorts of numbers being bandied around in terms of how much investment needs to be made to achieve energy transition. But what we know is that the numbers are big, irrespective of which number you believe. I mean, there's 2 numbers I can point to here. One of them is the CERE's Clean Trillion, which sort of says we need to be investing about $1 trillion a year to decarbonize our economy. Then we had the IPCC reports, that special 1.5 degree report in 2018, late 2018, and their figure was 2.4 trillion. But the point here is it's being measured in trillions. So, you know, it's a lot of money that needs to be raised, and so that's part of our context in terms of raising money. Interestingly, as a finance researcher, for many years I was considered a quack looking at energy markets and clean energy finance, but this area has completely exploded, and so now you're getting all sorts of special issues of journals looking at the issue of climate and energy finance. But like most finance researchers do, they look at secondary markets. So those of you that don't come from a finance background, so secondary market is once an instrument is already trading. So once a share, once a bond has been issued, is, you know, what determines its price in the market. And I guess one of our positioning here with this paper is that if we look at the policy literature, it really is a financing issue. It's about raising new capital as opposed to looking at what happens in secondary market. Of course, the secondary market and primary market are closely tied. If your share price, your stock price is doing well, then you're more likely to be able to raise more equity. But essentially, if you ask the policymakers, this is really about raising capital for you know, new energy projects, wind, solar, smart grids, the rest of it. And so most of the current literature seems to be focused on secondary markets. You know, the stuff that you do get on primary markets generally focuses on debt. And in particular, there's quite a growing literature on green bonds. Understandably, debt is the sort of largest component that you know, debt and project finance and asset rollout route will be the largest component of these trillions. But risky equity, it needs to be raised. So, you know, even though it's not a particularly large amount, the amount of equity that needs to be raised relative to equity. If you don't have equity, you can't raise debt. In other words, you need skin on the game. The people issuing the debt, you know, will want you to have obviously an equity position. You need equity to be a going concern. So we look at raising equity, and in particular new equity for firms that are coming to the market. So green IPOs is really our initial primary focus, but also if we think about energy transition, this isn't going to happen overnight. This is a multi-decadal issue. So you might still continue to get some brown IPOs in the energy sector. So fossil fuel related IPOs. So this comes from the Frankfurt School UNEP report on clean financing. And so it's, again, if you're not necessarily from a finance background, it's kind of useful to think about this continuum. So it's also, if you've read a little bit of Joseph Schumpeter, he came up with this trilogy of invention, innovation, and diffusion. And so diffusion is the rollout, the actual buying of the kit, the spreading of a technology through its market. But you have an early stage where you develop you have a technology research like would happen in a university, and then you start to develop prototypes. And once you've got a working prototype, then you need to build a factory that sort of can mass scale that, and then you have the rollout. And so this is like the technological development process. And of course, finance plays a really important part in all this. So obviously governments tend to fund most technology research, and then the development comes to private venture capital and to some degree venture capital. And then you get public markets. And it's really this sort of this end of it, so going from technology to development to manufacturing, or, you know, once public markets sort of come into play, that we're interested. And of course, we're interested in the IPO process. The other thing is, so to emphasize, so asset finance, again, this is from the Frankfurt School, UNEP, you know, asset finance, so the role, you know, paying to build wind parks and so on. This is for clean, renewable, global investment in renewables, is really the largest portion. And so public markets, which is really what we're looking at, it looks like a tiny proportion, but my point earlier was that actually this is important stuff because it raises that core risky equity that firms need to function in the first place, from which they can leverage debt positions. And so that's the sort of broader big picture context that we're working on. So to recap, not that there isn't that much research on the financing side, on the primary markets. What is primarily focused on green bonds, and so we're looking at that equity side. So we're looking at green versus brown IPOs, as I said. Brown, sorry, that should be brown. Apologies. These slides, as I said, it's the first time I presented this paper. So yeah, slides were done yesterday. So green versus brown IPOs. It's a unique data set actually developed by my co-author, Pia Helbing. So she's at Leeds University, as I mentioned, and before that was in Dublin, where she did her PhD and developed this unique data set of IPOs across Europe. And yeah, it's a very comprehensive data set. And I met Pia a couple of years ago at a conference here in New Zealand at Queenstown, and she told me about this data set, and I said, oh, have you thought about looking at it at energy IPOs in this, and that's the genesis of this paper, and then we got Freddie working on this paper, and so Pia, so from her own work, those of you that are in the States that may wonder whether we have many IPOs in Europe. They have many IPOs in Europe. Actually, over the 2015-2001 period, the IPO market in Europe was larger than in the US. So I guess there's two reasons to be looking at Europe. We can argue here it's the largest IPO market. And also, Europe has definitely been the leader in energy transition. So there's two good reasons to be looking at Europe in this context. There is one prior paper that has actually looked at IPOs in Europe. And so that's by Anderloni and Tanda in 2017. They looked at 144 IPOs. They found that in other words, brown IPOs were underpriced and performed better. And so we build on that. We look at, in addition to what they've done, we looked at the time dimensions, and we find that the results, although our baseline results are consistent with that, we find that over time things change. In addition, we do withdrawal analysis, we do a survival analysis, and we look at the ownership characteristics. So, you know, it was a great start on this topic, but we take it a whole load further. So in terms of our research questions, so are green IPOs taking over? This is really just a descriptive that we'll show you in terms of the evolution across time of brown and green IPOs. Are green IPOs more likely to be withdrawn? So often when you're looking to float a company, sometimes IPOs get withdrawn. Sometimes it's due to market conditions. So like right now, during the COVID crisis, there won't be any IPOs. When markets are generally heading south, there won't be any IPOs. But under normal market conditions, sometimes IPOs are pulled, and that's generally seen as a negative market signal. There's maybe just not enough demand for the IPO at that time. The other thing we do is look at sort of survival estimates. So how long, for those that are withdrawn, how long do they stick around? What happens to them? There's several outcomes that can happen to them. They can go back to the market again. They can be bought out, or they can go bust. The third question we look at is, do green IPOs have more favorable ownership characteristics? So by favorable, do insiders keep more equity? In other words, do they keep more skin in the game? And so this is a signal to say, you know, I'm really excited about the prospect of this firm versus actually I've sold out a bigger position and I just want to take my money off the table. So two very, very different things. So the retention of insiders should be a really good signal in terms of what the insiders feel are the prospects of the firm. And also what the role is of venture capital, because venture capitalists are the investors. So, you know, are venture capitalists backing green and brown IPOs before they go public? And VCs generally support high growth, high risk firms. And then how do green firms and brown firms perform post IPO? And so we use two types of models, buy and hold abnormal returns and a 4-factor time series model. We also, Pia, recently did some additional analysis to see how these firms were performing during the COVID crisis. Okay, so let's move on. So our hypothesis, as I said, this is the first time we present the paper. So I think there's scope to develop some of these hypotheses. Actually, I remember when we did hypothesis 2, I sort of debated this quite a bit with Freddie, but anyhow, let's go through the hypothesis. So hypothesis 1A, green IPOs are more likely to have greater venture capital involvements, whilst brown ones are likely to have more private equity involvement. And so, as I mentioned, this is likely because generally green has been seen as risky in the literature. So if we look at all this literature, the underwriting message that comes out of it is that green investments, green energy stocks or so on have been seen as high risk. So, you'd expect venture capitalists who go for high risk capital to new ventures to have a greater proportion of green IPOs. But then we also conjectured that private equity investors would go for brown IPOs. And the reason for this is private equity investors tend to go for more mature firms with operating or financial issues. So yeah, we had a dichotomy there. Green, we expected to see more venture capital investment, whereas brown, we expected to see those smart turnaround sort of leverage type people coming into firms that perhaps weren't being, that had some financial issues or operating issues and trying to turn them around. And then once they turn them around, they take them public, which is what private equity investors tend to do and do so invariably quite successfully, very successfully. Then the hypothesis 2B is green IPOs will have more retained ownership than brown. So this is the growth versus selling out story that I sort of intimated in the previous slide. So growth in the context of green IPOs, and perhaps if we believe in energy transition and that some of the brown, the owners of brown companies might be in the process of reducing the stake as transition perhaps begins to feel real. And so that's the hypothesis 1B. Then we have hypothesis 2. This is the one I sort of debated a bit, and I think we probably need to look at the literature some more. But as I said, there is quite a lot of strong evidence that green firms generally, green funds have tended to underperform and be more risky. So if you follow that logic, then we would have a higher likelihood that they would be withdrawn. But if you buy the growth story, then there's a flip side to this hypothesis. So to be honest, it could go either way, and I'll wait till we get to it for you to find out which way it actually did go. Excuse me, it's early here in New Zealand. So hypothesis 3 is green firms have worse IPO performance than brown firms, and on this one there is quite a good deal of evidence, including the previous paper on European energy IPOs that classed them as renewable and non-renewable. So that hypothesis seems to be well-founded. Okay, so the data is between 2000 and 2017. So as I mentioned, it comes from Pia's work, her PhD. So the overall data set has 3,000 IPOs, initial public offerings. And of those, 2,658 were successful, 359 were withdrawn. So this is the data set that she mentioned that when I met Pia at a conference in Queenstown, and we said, well, let's look at the energy ones, and let's look at the withdrawal and the performance of it. And so the first thing we did is we looked at classifications, industry classifications that we felt were relevant to energy transition. So we took Bloomberg industry classifications, we took energy, transport, and building materials, and that gave us 310 IPOs to look at. But we needed to code these and make sure that they were green IPOs. So, we developed this definition that looked at green IPOs. So a firm with a majority, over 50% of their operations as measured by revenue, focused on renewables, greenhouse gas neutral, reducing methods, technologies, and associated enabling green services and technologies. So it includes renewable energies, clean building materials, clean buildings, electrification of transport, and enabling technologies. Most of them, it was relatively straightforward to code, but then there were some that were extremely difficult to code. And so, this was what really labor intensive stuff we would, if it wasn't straightforward. So one of the things we looked at is, it was interesting, some firms talked about renewables in the company description, and then you looked at the segmentation of where their revenues came from, and that maybe 10% of their revenues came from renewables. And so that was, in our classification, not a green energy firm. So it was interesting in the company description, maybe they were trying to get some element of green glow, so to speak. But actually, when you looked at it, the detail, they weren't necessarily green. So we used a whole load of data sets. So IPO prospectuses, Capital IQ, Bloomberg, Aiken database, and other sources to code them. Freddie, the main researcher on this, did the initial coding and then checked it, and in particular, the ones that were most ambiguous, we spent quite a lot of time on. But in the end, there were 26 that either weren't really energy related, energy transition related, or there was just not enough information for us to code them. We excluded nuclear, but to be honest, I don't imagine there were too many nuclear IPOs. So I don't suspect that is much of an issue. So we ended up with 90 green IPOs, or potential green IPOs, and 194 brown IPOs. So 284 in total of green or brown, of which 38 were withdrawn. Okay, so our sample of withdrawn is relatively small, but we still run some analysis on those. So those are that's the data. This gives you a sense of PS data set. So we've got the green and the brown IPOs, but we have all these market characteristics. So what's happening in the market, that's so we can control what's happening in the market. We also have this firm and offer characteristics. So we've got, how many primary, secondary shares are being offered, the involvement of private equity and venture capital, is intellectual capital a big part of the firm, firm size, age, and so, this is the great value, and, the data set that Pierre constructed really mirrors IPO research in the US that has looked at the IPO issue in a great level of detail. So it sort of builds on that. So the other, is high tech, what level of debt was there, and then governance issues are also in there. But, some of our variables are of interest are private equity, venture capital, if you think back to our hypotheses, and also retained ownership is another critical variable of interest. So models, so for ownership, so we do a probit model with a green dummy as the dependent variable. And so we look to see if, we look at the venture capital and PE dummy. So we expect that to be positive, this to be negative in hypothesis 1A, and retained ownership to be higher for green firms in H1B. For the withdrawal analysis, we also have a probit model, but in this case, the dependent variable becomes the withdrawal dummy. And we have as variables of interest, a green dummy to test H2, and we have firm and offer and market conditions all as controls. We also do a survival analysis, so semi-parametric Cox proportional hazard model based on what's been done in the literature. And for post-IPO performance, again, there's two main models that are used in the literature. So the buy and hold abnormal returns which takes your abnormal returns from T1, so that's the first day of the firm's been trading, through to the 36-month period, or unless the firm goes out of business before then, and you compare that to the return on the market, so RMT. We also run a four-factor model, so this would be Pharma French 4 factors, and so it's the excess return, return on company T, at company I at time T over the risk-free rate, and you have your Pharma French controls. And what you're interested in is here your 4-factor alpha. This tells you if there's any abnormal returns there that are not accounted for in the model. So this is what you look to do. To be honest, in this presentation, I'm only reporting the buy and hold abnormal returns. In the actual paper, we have both, and they tell the story, the same story. Both models have their advantages and disadvantages, but as I said in the paper, we do both, and they tell us exactly the same story. Okay. Let's move on. So results descriptives. So perhaps not surprisingly, the UK is so this shows the absolute number of IPOs in the data set, green and brown, by country. And so unsurprisingly, the UK is the largest capital market in Europe, and it had by far the largest number of IPOs, green or brown IPOs. So there's a real dominance of brown IPOs. A lot of those may be smaller companies in AIM, the alternative investment market. And so we do have a control there. So a lot of these will be exploration companies working across the globe, looking to finance, raise equity in London, and then go and do projects around the world. Most of you will be probably aware that the UK stock market has been through a really hard time the last 5 years. One of the factors there, no doubt, will be Brexit, but another factor will be the fact that the UK market does have a lot of fossil fuel related companies. Germany has quite a green profile. So not many brown IPOs. Norway is more like the UK, and so that's the sort of geographical distribution of this data set. And so that first question I ask is, what's happening over time? If we believe in energy transition, then we would expect to start to see less green, less brown IPOs over time. And we see that up to the GFC, the data set was really dominated by brown IPOs. There was a number of green IPOs. You start to see a growth of those in 2005, but brown IPOs outstripped them by quite some margin. We obviously then have the GFC and 2009, which goes back to my point when markets are heading south or going down. You basically don't have IPOs. So 2009, just essentially nothing happens. And actually later on, we split the sample between 2010 to 2017 and 2001 and 2008 to look at how performance changes over time. And we see some quite large differences. So we still see generally more brown IPOs than green IPOs, but the proportion is looking closer, nearly half and half, if you go from 2012 onwards. So you are seeing that evolution. The number of brown IPOs is generally declining. It's hard to say that post 2009 that the number of green ones are going up either. So yeah. Okay, so the first empirical results, I'll just stick on time here. So this is, we run various number of models. So we had a lot of explanatory variables. So we run I think it was the collapse function or the build-up function. I can't remember which of the two, just to try and handle these issues. And so we're testing H1A, and oops, that should be H1B. Sorry, as I said. Oh yeah, no, sorry, that is H1A. That is correct. So we're looking at ownership variables. So we've got green as the dependent variable, and we've got three variables of interest: venture capital, private equity, and retained ownership. And so here we have the coefficient, and we've got the marginal effects in our three versions of the models. So consistent with what we expected, there is significantly more venture capital investment in green IPOs. And if you look at those marginal effects, they look pretty large. Yeah. Contrary to what we expected, there's more private equity in green IPOs. Although, you know, the effect disappears, but you know, this model is probably over-identified. Yeah, so it would seem that that's contrary to our hypothesis. Actually, private equity investors are more likely to invest in green IPOs, so, which was an interesting result. But I think that the most interesting result is around retained ownership. And as expected, and this is consistent across all our models, higher insiders keep a much higher proportion if we look at these marginal effects of ownership in green IPOs and in brown. And so that's that sort of hanging on to a growth, keeping a high stake in a growth story versus selling out as a motivation for IPOs. So, you know, you could conjecture that there's two strong motivations as an insider to raise money externally through capital markets, through an initial public offering. One would be to get additional capital to expand your business. The other one would be to sell down your stake. And so, yeah, here our results would seem to be consistent with H1B, which I actually think is one of the most interesting results from the paper. And, you know, would hint that, you know, yeah, you know, it hints strongly that even in the IPO market, energy transition, the effects of energy transition are felt in terms of ownership. So the next analysis is the withdrawal analysis. So here, withdrawal is the dummy variable, and green is marginally less likely to be withdrawn. So it's marginally significant. So green firm dummy. And so we had conjectured that they would be more likely to be withdrawn because there would be higher risk, but then that needs to be counterbalanced versus that growth story. So it seems like they're less likely to be withdrawn. We did in one of the models, in model 1, do a pre-2011 the dummy interacted with the green dummy, and that hints that our original hypothesis probably was correct, but things have changed over time. So, you know, from this you might conclude that pre-2011 our hypothesis was right. Post that, probably not. So it sort of suggests some changes over time on this issue. So then we took I think it was 38 we said had withdrawn. Let's go back. Yeah, 38 that had been withdrawn. And so we categorized the outcomes. So the firm could go private is one outcome. They could become inactive, in other words, go bust, or they can be acquired, or they can ultimately be go to the market. So try IPO a second time and successfully IPO the second time. And so this is the sample of all withdrawals for the data set. Here we have the green withdrawals, and here we have the brown withdrawals. And you see, this is the sample of all withdrawals with across the two categories, green and brown, and this is across the whole EU dataset, PIA's complete dataset. And you see that there doesn't seem to be any obvious difference if we take green and brown and the overall dataset. But if we compare green and brown, there seems to be some difference here. Green are more seem to be 41%. I mean, these are small numbers, yeah, but it's all we have. So we can only use what we have. 41% of this of the green ones that were withdrawn went private, versus 28% for the brown ones. Another really interesting feature is, so a lot of them go to M&A, they merge or they get bought out. And so this is what I'll present the survival analysis there, but the number of months that before they're bought out. So the brown ones, it's about 17 months, whereas the green ones, it's a lot longer. And so that leads to the sort of survival analysis. And so we have the brown ones here that are actually sold very, very quickly. And whereas the green ones, there's a sort of there's a slower approach. I guess there's two ways of interpreting this. One is, the brown ones have such great prospects and have such great cash flows that they can achieve very, very rapid M&A outcome if they don't IPO, or either that or the owners are very quick to offload it. So again, it ties in with these selling ownership stakes. There seems to be that's the other side of the coin. So either they find it very easy to find buyers, or the owners are very keen to sell quickly, versus the green ones, they are in less of a rush, or the flip side is they could find it harder to sell. But I guess our interpretation is that they're being sold a lot quicker, the brown ones, and we would argue it's consistent with this insiders looking with brown ones to sell out quicker, with green ones to retain ownership. I think if we didn't have this result, I don't think we could add an interpretation to this. But given that earlier result, I think we can take the story that green are keen to keep a high stake and are not willing to sell out at a relatively cheap price. Actually, and then when we look at underpricing, this is also consistent with that story. Okay. Again, let me just check on my time. Yeah, I've got about 10 minutes, and so that we have plenty of time for Q&A. So let's look at post-IPO performance. This is just monthly returns. And we've done a brown graph for brown ones. And so what we see is that in the first month, brown firms return nearly 11% on average across those, brown IPOs, did I say green? Brown IPOs return around 11% in the first month, versus about 5% for green. And so this is what we'd call underpricing. Sometimes underwriters who help shift IPOs will underprice them just to make sure that the offering gets sold, to make sure that there's enough demand, that enough investors sign up. So, from a company perspective, if you saw this and you were an insider, you'd feel like potentially your company was sold too cheaply. So, this is a market signal saying that perhaps investors need a bigger discount. In other words, a bigger underpricing, a bigger initial return to induce you to buy these firms. So this is hinting that brown firms are underpriced, quite materially relative to green firms. But if we look at 12 months onwards, you see that green firms tend to be underperforming brown firms, and they tend to be underperforming the indices. So we have the DAX, the FTSE, a whole load of indices there. This is quite common. Generally, IPOs underperform, so they have a good start and then underperform in the subsequent periods. But the key point here is that there is this sort of underpricing of brown IPOs. Again, a negative sentiment, signaling a negative sentiment there. Yeah. And so this is the post-IPO buy and hold abnormal returns for the period, for a sample period. So 73 green, 173 brown, because that's excluding the 38 withdrawals. And consistent with H3, I come up with Giporo and green IPO relative underperformance. So we do see a relative underperformance of green IPOs. So this is when we compare green versus brown. They underperform and quite materially. So consistent with our literature showing that green firms underperform, consistent with the prior paper that looked at IPOs in the European context. They also, as I said, found this issue of underpricing. So on the post-IPO performance, at this point, we really have not added too much to the prior paper. So what we take also is we ask two questions. So is this underperformance being driven by this initial underpricing, where brown investors are almost being given a reward for investing in brown, or being paid a premium for investing in brown stocks? So is that explaining the green underperformance? And has this changed over time? And so in the previous empirical results, there was hints that things were changing over time. And so to answer the first question, we excluded the results of the first day. Perhaps actually, maybe we could exclude the first week. But we showed that even though the significance goes up in terms of the underperformance, the magnitude, especially in the first 12 months, decreases considerably. So the underperformance is not as severe at 12 months, not as severe at 24 months, and slight improvement at 36 months. So that explains some of it. As I said, we only do the first day. Maybe we should just also look at a week. But is it weakening over time? And so this is our baseline result that you saw before. So, green IPOs underperforming really markedly relative to brown IPOs. So we first try a post-Kyoto sample. So, we lose a few years from the early part of the sample. And actually, it really reduces the 36-month performance. 24 months is reduced a bit. The 12 months is reduced as well. And the difference at 36 months stops being significant. We then split the sample. We dropped 2009. I think if you remember, 2009, there was virtually no IPOs following the 2008 crisis. So it sort of worked out quite fortuitously for us that we have half the sample here and the other half of the sample there if we drop 2009. So we have equivalent number of years either side. And the results are really interesting. So if you take that first half of the period, the result is even stronger. It's significant at 1% level, and the relative underperformance of green is really marked. Once you go from 2010 onwards, the effect is reversed. Okay, apart from that 12 months, but overall the long-term effect is reversed. Even though it's not significant, but your coefficient has switched. So the overriding conclusion, and so this adds to the prior paper, is that this underperformance was related to earlier parts of the years, and sentiment in green seems to have at least made the underperformance not significant, and if anything, the suggestion that green IPOs may be starting to outperform, if anything. Lastly, we looked at how these stocks were performing relative to green and brown were performing in the context of a shock. We took the OPEC oil price related collapse, the failure to have that initial OPEC agreement. Obviously, we then got a OPEC plus agreement, but it didn't seem to help the oil markets. It seemed to, if anything, make things worse. And so what we have here are the benchmarks, and what we see is green IPOs clearly get hit hard. The whole energy sector gets hit hard, but there's quite a gap between green and brown. Brown are hit significantly harder. That's just a descriptive running the buy and hold abnormal returns. So it's not significant, but it would seem that if anything, green are doing better. Haven't had a chance to put the Pharma French 4 factor, but we ran some, Pierre ran some Pharma French 4 factors in which we included oil as a control. And yeah, the effect seems to be holding in the 4 factor regressions. And it seems like brown are underperforming even after you control for the oil price. Okay, so just conclusions. So just to sum up, withdrawal. So green firms marginally less likely to withdraw, indicating a positive market sentiment. So this was against our hypothesis. Survival analysis, brown firms are sold quicker. And in the context of our other results, we take this to be a signal that insiders are keen to offload these positions, their ownership positions. In terms of ownership, private equity and venture capital involvement in green. So you could, if you believe PE and venture capitalists are smart money, it could be an interpretation that smart money is going towards green. As an alternative interpretation, more internal cash flows for brown firms, and that's certainly the case there. You know, they are very high cash generating businesses, even though they're you know, the valuations may be low. They're definitely generating a lot of cash, or pre-crisis were generating a lot of cash. The PE private equity result is surprising, but what is strongly coming out, and I think is probably our headline result, is this retained ownership. You know, there's more retained insiders retained ownership for green IPOs. So overall, our results indicate a poor long-term outlook for brown firms. So it would seem that the IPO market is beginning to reflect you know, energy transition. And in terms of our post-IPO performance, yes, we do find this green relative underperformance, but that weakens over time. In fact, it doesn't only weaken, it disappears over time. And brown IPOs are more heavily discounted, so that also helps explain that green underperformance, and brown have been more severely impacted by the COVID crisis. So yeah, that's it. So I think we have some time for questions. So I'm looking at question. Okay, so I'm getting quite a few questions. Thank you very much for this. So you show that IPO ownership by VC and PE is higher than green firms. Who is owning brown, and what is intellectual capital? It's a good question. Who's owning brown? Yeah, so I guess so V and P would be present before they go public. So before they go public, then it would be insiders, other private investors, and once they are public, it would be institutional investors. What is intellectual capital? Let me find the variable definition, but Pierre's probably the best person to contact about this, but it was a measure, and so this is something we discussed quite a lot, because one of the concerns I had was whether green IPOs were just a proxy for higher tech companies. But that's what this intellectual capital a variable aims to capture. And actually it seems to be, if I remember rightly from the descriptions, higher for Brown. And so it was, I think it was a dummy variable that looked at the prospectuses to what in degree they talked about intellectual capital, patents, that sort of thing. Yeah. So another question is, you calculated post-IPO returns using equally weighted, might be worth be doing value weighted. Yeah, certainly. Thank you for that comment. We could certainly think about doing value weighted. What percentage of global energy investment, public-private, goes to your IPO data set represent? Yeah, I guess that's another one we'd have to look at by another person called Ivan. Do you think the comparative performance between brown and green IPOs may be linked to the structure performance of VCP and other investors? If there are different dry powder levels in VCP structures and other investors, can it lead to different results? Okay, so again, I think, Ivan, thanks for that question. Again, I think that's one we would have to think about. So yeah, this is about the structure of VCP and other investors, and how that can affect the different results between green and brown. So yeah, we'll definitely take that on board and look at that. I don't see any more questions coming through. So I think if Dave, you want to come back in, I think so yeah, thanks Ivan for that question. I think we'll have a look at that and see how we can capture that. So yeah, I think that covers all the questions as far as I can tell.
Okay. IAEE wishes to thank Ivan Diaz-Rainey for an outstanding webinar. I know I personally learned quite a bit, and we're very grateful for your participation today. For everyone listening, this webinar has been recorded and will be posted on IAEE's website for future download. If you're not already a member of IAEE, we encourage you to join by visiting us at www.iaee.org. We thank you for attending, and now I officially close this webinar. Thank you.